This is the Real Estate Investing 365 podcast, your go-to source for real estate investing strategies so you can start living the life you want and get where you want to go. With your host, Justin Hanna.
Welcome back, everybody. Another episode, Real Estate Investing 365. Today, I got with me Paul Moore. He is the founder of Wellings Capital. His company has over 17,000, probably more at this point, self-storage, mobile home park, and multifamily units. And he is the author of a book called The Perfect Investment, Create Enduring Wealth from the Historic Shift to Multifamily Housing. He's doing lots of big things and maybe not fully focused on multifamily right now, but Paul, thanks for being here. Appreciate it.
It's great to be here, Justin. Thanks. And just to be clear, we don't own all those units. I'll tell you more about that later.
Okay, perfect. I'm excited to dive in. But before we go into like your current business operations, why don't you give me kind of a background and a history on yourself, how you even got into this career of real estate in the first place?
Okay. So I went to school and I didn't know what I wanted to do. I thought I wanted to be a Ghostbuster, like a parapsychologist. And I found out they had no degrees in that. Come on. And so I was pretty good at math and physics. So I got a degree in engineering, which was my first mistake. And then I got an MBA, which was not a mistake. I went to Ford Motor Company for 5 years, and I found myself tinkering all the time, looking for something to do on the side. I liked Ford, but I was bored. And so I actually started a staffing company. I partnered with a friend who was already in the business. I came alongside him. He taught me the ropes. And we were fortunate enough to sell that company 5 years later for millions of dollars. And I was in my early 30s. And so my family moved to the Blue Ridge Mountains of Virginia, and we eventually, after a couple of years of false starts, trying to start a nonprofit organization and some other things, decided to get into flipping houses. And so that's how I got into real estate. And then I've been literally involved in over a dozen aspects of real estate investing over the last 20 years.
Okay, cool. So you kind of went from the typical, go to college and get a job with a big company. And then obviously as a go-getter, and how most go-getters are, they find themselves to be a little bit bored at those companies or wanting more in life. And then you started your company, ended up selling it. So where did then you guys moved to Virginia, but how did you even get the idea of real estate or to move into like flipping houses? Was it just because it was a great time or you met somebody? How was that?
Yeah, so flipping wasn't even a word at the time, but this guy was teaching my son and I how to bow hunt, and another friend of mine had moved to town. He had all kinds of experience, like decades of experience in maintenance on apartments, and so he wanted to do some kind of real estate. And so this bow hunting guy was like, "Hey, my dad owns a bank. And when these houses get foreclosed on, they sell them on the courthouse steps for like 30 to 60 cents on the dollar." And we're like, "What? You've got to be." So we went down. My buddy and I, on an icy, snowy day in December, we actually went down to the courthouse steps. We intentionally took no money with us. We did not want to take any money because we knew we'd be tempted to bid on this house. But we did a dry run. We acted like we were going to bid. So we went and checked the house out. We did the comps, did the tax assessment, and we came to the conclusion it was worth $65,000 fixed up. And the thing is, it looked like it was fixed up. We peeked in the windows. It was vacant, and we didn't see anything wrong with it at all. It was even swept clean. So we went down to the courthouse steps thinking, man, if this thing goes for under 50, we didn't know what we were talking about, but we thought somebody's going to get a good deal. Well, they opened the bidding at 33 or 34,000, and guess what? There was nobody else there. So we were kicking ourselves, and we begged the lady to go to lunch. We said, "Look, there's Taco Bell. Why don't you go to lunch and we'll be back here. We'll meet you back here and we'll have a cashier's check." So we did that. We brought a $3,400 cashier's check, 10% down. We bought the house, put a for sale by owner sign in front of it, and 4 hours later had a full price offer at $65,000. Wow. And so we thought, this is easy, as they say. Right. And we could do one of these a week. Well, we found out it wasn't easy to acquire houses like that. That was an anomaly, and it wasn't easy to make a profit. So we lost money on 2 of the next 5 houses, but we did dozens and dozens of houses, and that's how I got launched into real estate.
And that was all there in the Blue Ridge Mountains where you live now?
Yeah, believe it or not, that was in a town called Martinsville that had 22% unemployment at the time. And we were just very fortunate, very blessed that somebody drove by it right when we put the for sale sign out who was looking for a house on that exact street.
Okay. What year was this that
That was in
that started?
2000.
Oh, in 2000? Okay.
Yeah.
All right, right on. So then you get into the flipping business, you start doing dozens of houses. You realize, this is awesome, but it's not quite as easy as I had imagined, but I'm sure you're a smart guy. So you created a business out of that. What was the next steps after the flipping or wholesaling business that you had kind of got into?
Yeah, so we did a rent to own. So we started doing rent to own homes where we would hold the paper on it. And we found out, of course, we were able to refinance those with the bank. So we were able to cash out pretty much our equity stake. And then these rent to own buyers, we heard at a seminar that 70 to 80% failed to close. And we thought that was ridiculous. But you know what? We found it was true. And so they would give us a nice large deposit check, anywhere from $3,000 to $10,000. They would move in, they would be paying us a premium for rent. And then 2.5 years later, like clockwork, they would end up getting another job or situation or divorce or whatever, and they would leave town and the house would be back in our lap. And usually it would be well cared for. So we would do it again. And so we went from that. We did a handful of rent to own or lease option sandwiches, which is sort of a subject to type thing where the original mortgage was kept in place. And then I told my partner, I said, hey, if we can make this much money flipping houses, how much could we make building? So we started building modular homes. Modular is a type of home that's popular in this part of Virginia. I don't think it's that popular around the country. It's a stick-built home, but it's pre-built in a factory and hauled on site and then set up. And it's not a mobile home, it's a real home. But we did that, and then I did a couple stick-built homes. And Justin, I found out that if you don't know how to tighten the doorknob on your own home, you probably shouldn't build a $500,000 home from the ground up.
Yeah.
Who would have thought?
Yeah. Who would have thought?
Anyway, we did that and actually lost. I should have made 100,000 on a house easily, and I lost 40 on it. And I realized that's not what I wanted to do. But around that time, the senior vice president of Freddie Mac calls me. I kid you not. And he said, I saw your website here at Smith Mountain Lake in Virginia. I want to buy a vacation home there. And I've called 7 realtors. None will call me back. And I see that you're a builder, but I see you have a realtor license. Would you help me? Well, I made like 15,000 in commission for like 20 hours work. And I thought, I just made more than I made in like 8 months building this house, obviously a lot more. And so I transitioned at that point to actually having a website that generated leads for realtors. And I still have that website 16 years later. And I still make, a pretty good amount of money on that passively. So that's been fun. Anyway, we actually eventually built a multifamily ground up facility in the Bakken oil rush in North Dakota. And that's when I discovered the magic of commercial real estate. And I will never go back, I promise you.
Yeah, never go back to the residential stuff, huh?
Right.
I hear you. So, okay, so you did a lot of different things, and this is probably at this point when you just, went to North Dakota. It was probably what, like early 2000s?
2011.
2011?
Yeah.
Okay, 2011, which is a great time, obviously, to get into the commercial real estate space. How did you decide to go out there to North Dakota? Because you're kind of stuck in this area. You're in the Blue Ridge Mountains. It's kind of obviously a small community type area.
Mm-hmm.
How did you decide on a new area to go to?
Yeah, that's a great question, Justin. So I did quite a few other things I didn't tell you along the way here. So for example, we flipped high-end waterfront lots at Smith Mountain Lake in Virginia. So I got to know how to buy and sell land. And also I invested in oil and gas. Now, in North Dakota, there was this huge oil boom, but I wasn't content with just making 10 or 20%. I was a speculator. Now, I thought I was an investor. Investing is when your principal is generally safe and you've got a chance to make a profit. Speculating is when your principal is not at all safe and you've got a chance to make a profit. And so I was a speculator, a shiny object chaser. And so I couldn't just go for a normal return in the Bakken oil rush. I had to go and invest with a wildcatter, a guy who was on the fringe and was going to make 100x, and he had an amazing system of locating these really powerful, deep, very profitable oil wells. Well, we invested with him. A bunch of my friends joined me, and that didn't turn out well. We actually bought land. We invested in land leases over like 1,000 acres of land. No, not 1,000, thousands of acres of land that he would eventually drill on, and it did not work. But what we found is that nobody could find a hotel room. When we would go there, we'd have to fly back home the same day or fly out of the North Dakota region. There was 18,000 job openings. There were cars and trucks lining the Walmart parking lots and the Waffle House and the rest stops because all these guys had no place to stay. And so we said, hey, my buddy and I were both in real estate. We can build a multifamily facility very quickly. And we built one in unbelievable record time. And we got it up and running one summer. And we started leasing this out, and we were able to lease out space. The average going rate across the country, Justin, for multifamily is something like $1 a square foot a month. In other words, a 900 square foot apartment might rent for, roughly $900 a month. We were actually renting our space for $13 a square foot. The oil companies were paying for it. Now that included all the furnishings, electricity, internet, cable, etc., but furnished corporate housing. But we were crushing it, and we had a great time doing that for years.
Wow, that's crazy. I actually knew somebody. I bought a truck a couple years ago from a guy at a car dealership, and he was working in the oil fields out there, and he said it was crazy. You know what I mean? He was telling me all about trying to find places to live or whatever, but then the oil industry kind of collapsed at that time, and when it was 2015, I guess. And so
we sold in August of 2013 when the oil prices were over $100 a barrel. And within a year, they were down to $30 a barrel. And the guy who bought from us, now our theory was if we build the nicest place in town compared to the man camps that were coming in town, if we built the nicest place in town, we'd be the last man standing. And that's exactly what happened. They're still making a profit today because we built a very nice place.
So the guy that you ended up selling to, they ended up being able to keep it and not going in foreclosure because there's still some jobs there, like not every single job left, but just
there's lots of jobs. Absolutely.
Yeah. Okay, cool. So you go from that property, you sold in 2013, and you got the multifamily bug. Then you kind of moved into what? More syndication, bigger complexes, storage units. What was your next move?
Yeah. So what I learned was, and honestly, I'm jumping slightly ahead here, but I'll run back to where I went next. But what I learned was this thing called the value formula. Now, Justin, if you and I bought a house to flip and we spent $300,000 on it, and we added $500,000 in improvements, which would be crazy. But let's say we finished unless you're in LA, let's say we finished the attic. We finished the basement, we built on a huge addition, we put in gold-plated fixtures, and we had $800,000 in it. Now, if that was a $350,000 neighborhood, and I know that you're not going to get that $800,000 back out of it. Well, it's very different in commercial real estate. Commercial real estate doesn't operate by comps like residential comparable properties. It appraises based on a formula, and that's a value formula. And if you hear nothing else in this podcast, please write this down. The value of commercial real estate in general is the income divided by the rate of return. It's sort of like stock market. It's sort of like a price to earnings ratio. So it's the value is the net operating income divided by the capitalization rate or the rate of return. The cap rate is basically the expected rate of return, unlevered rate of return for that type of asset in that market, in that condition, at that time. And so that's the cap rate. The net operating income is your gross revenues minus your operating expenses, not including debt, not including depreciation. So if you can drive up the net operating income and keep the cap rate the same or even better, which is possible, you can dramatically increase the value of your asset, and then with leverage, even more increase the value of your equity. So I'd like to propose, Justin, that we jump back into that with some examples when I get there. But I just want to make the point that when I discovered that formula, I think I didn't even believe it for a couple of years. But I jumped back into multifamily. It was 2014, I think. And jumped back into multifamily. But I decided that doing ground up development was actually scary, possible, more of a shiny object thing. I was in my early 50s and I was like, man, I don't want to take these risks. What if something happens to me and I keel over someday and I'm in the middle of one of these down, cycles? So I decided I wanted to start buying apartment buildings. We started Wellings Capital, and our goal was to buy Class B value add apartment buildings. So we went through an intense, expensive mentoring program first to up our skills and our knowledge of this and learn about syndication, which I didn't know much about before, even though I'd raised money well over a dozen times. I didn't know the syndication model. And then we built a website, and then we tore it down and built another website. And then we built free special reports. And then I wrote a book. You can hear in here what I wasn't doing, and that was I wasn't raising capital and I wasn't buying multifamily. Now, part of it was one of those kind of stall tactics, like I really didn't want to learn to raise capital from the public. I thought friends and family would take care of it, and that wasn't true, as my mentor told me over and over and over. And but the other reason was multifamily got overheated. Now, in 2008 and 9, multifamily, like everything else, took a downturn, but not as bad. Not nearly as bad as other sectors of the market. And if you want, we can jump back into that. You can make a note of that. We can talk about that. That was amazing. But it still did take a downturn. But in 2014, 15, 16, 17, we were finding that we thought everything was overpriced. Now, I had friends like Michael Blanc who bought properties during that time. And I said, Mike, man, you're I think this deal in Memphis, I think it looks like you're overpaying. And he bought that, refinanced it, and by now in some cases has sold those properties for millions of dollars of profit. Well, I sat on the sidelines, so I was wrong. But I still think it was overheated. I still think multifamily is overheated. And even though I called my book The Perfect Investment, referring to multifamily, I think it's not so perfect when you can't find a deal that makes sense. So that's where I spent my next several years banging my head up against the wall, honestly, looking for multifamily.
Okay, so then what asset class did you guys end up getting into? Because I'm sure Wellings Capital, you guys do invest in properties and different types of real estate asset classes. So what direction did you guys end up doing?
So in 2018, it was early 2018, 2 years ago, I decided to peel back the covers and look into self-storage and mobile home parks, which I really had resisted doing anything but multifamily because I really loved it. And I was shocked, Justin, to find that 93% of multifamily, 50 units and above, are owned by corporations. They've already typically wrung the value out of those. About 90% of mobile home parks and about 70% of self-storage are owned by small operators. And often those are mom and pop operators. They don't have the resources, the knowledge, and frankly, they don't care about getting the maximum income and maximum value out of their property. And so did you know that there are 53,000 plus self-storage facilities in the US? That's the same as Starbucks, Subway, and McDonald's combined. Yet a huge percentage are in the path of growth, owned by mom and pops, outdated, and they have huge value add opportunities. Now, there are about 44,000 mobile home parks, and about 40,000 are owned by pure mom and pops who don't know how to maximize value. So for a ton of reasons, we fell in love with self-storage and mobile home parks. We didn't want to abandon multifamily though. So what we did is we began to look and understand how money is made in those different sectors. We understood it. I actually wrote a book about self-storage investing. It's coming out from Bigger Pockets Publishing in 2020. But we didn't want to do it because we didn't have the team, the track record, the experience, and we realized we were near the top of the cycle. So what we did is we started vetting best-in-class operators in self-storage and mobile home parks. In fact, we spent a couple of years looking for the best operators we could find who have outsized return, lower than average risk, and we started investing with them. Then we got friends and investors to invest alongside of us. And then in 2019, we opened a fund to throw open the doors to any accredited investor that was a fit with us to invest alongside us in these deals. And so that's where you got the 17,000 units. We invested in about, I think it was 47 assets last year. And we have a few multifamily in there, but mostly all self-storage and mobile home parks. So that's where we are today.
So how does that work? So you open the fund and you just go find other operators that are buying the deals. And then you say, hey, it's kind of like you're merging funds, you're merging syndications. You're kind of
that's right.
on an LP.
Yeah. So we will go into them and we'll say, look, rather than you have to, if you want to raise $5 million, rather than you bring $150,000 investors, why don't you just let us bring you for 3 million of the 5, let's say. Mm-hmm. And so we would do that and we would get a better deal from them. In other words, they would cut us a better deal, a better return, and we would pass that along to our investors. When we take a fee out, it basically nets out to about break even because those investors have a fee to pay us, but they also get a better deal than they would going direct.
Okay, so like a simple thing is if a operator is going to offer his investors an 8% preferred, either just, I'm making these numbers up just for simplicity. Right. He's going to offer an 8% return. You go to him and say, hey, I can raise the majority of your money for you if you offer us 10%, and then you give your investors, that maybe the 8% and you take the spread in the middle. Is that kind of how it works?
It's very close to that. It's different based on every single syndicator, and some of them already have it set up, Justin, so that a large investor, let's say $1 million plus investor, gets a much better deal. And so that's the easiest way to do it, so we don't have to negotiate a separate deal.
Okay, right on. Cool. No, that makes sense. And I want to jump back a little bit to the multifamily industry being like overinflated.
Yeah.
And so I kind of have, different thoughts on that because, going in the early 2000s up until the recession, it seemed like, cap rates were compressing the same way they are right now, and they're getting lower and lower. And then, the cap rates went higher, which gave us more room for profit during the recession. And then when we were coming out of it, and then they started coming back down. So are we just in the same path of like take the recession years out of the picture? Are we just on the same line that we were in, you know what I mean, to where this is where it's supposed to be? Or is it truly overinflated? And what do you think is going to happen going forward?
It's a really hard question. One thing I kick around with people on podcasts and friends is this the new normal?
Yeah.
So if cap rates are normally 8% or so, and right now they're averaging 5.5%, well, are they going to go back to 8%? Or is the new normal around 6 or 6.5%? Well, I would propose that if interest rates are staying down where they are now, and the projections are that they're going to for the next decade, then we're in a new normal. So maybe it's not overheated. Maybe the truth is this is a new normal. Now, I have 7 reasons I think it could be overheated, but even if this is the new normal, Justin, and again, even though at the risk of sounding like a weirdo who wrote a book called The Perfect Investment, even if it is the new normal, it is running too close to break even for my taste. I mean, one serious water main break or one huge, issue with a 1970s apartment complex, maintenance issue or CapEx expense. I had a $107,000 water main break a year and a half ago on an apartment we own. And you know what? It wasn't fun. And there was a risk that there'd be many more because the pipes are old. Well, honestly, that's just too close for comfort for me. I like the idea of having, if I'm projecting 4% cash on cash returns from operations, that's just not great to me. And I would rather be buying mom and pops that we can upgrade and see a 10 or 15 or 20% cash on cash return, which is very, very possible when acquiring from mom and pops of any type.
Okay. So mom and pops, you're talking like self-storage and mobile home park type properties?
Yeah, I can give you quite a few examples, but there's so many more self-storage and mobile home parks that are owned by mom and pops available than there are in multifamily. And that's what I'm referring to right now. Though there
Yeah.
are some in multifamily, I'm sure.
Oh yeah. Okay, so let's dive into that a little bit. How about we'll stick to the self-storage aspect of it. Now, um, couple questions. One is, how do you identify a market to go into for self-storage for somebody just looking to get into it? And two, is there a certain unit size that maybe you should stay above
Yeah.
if you're going to get into that asset class?
Great question. So if it's after May of 2020 when you hear this podcast, the answer is go buy my book. It's
Yeah.
available from Bigger Pockets Publishing. But in the book, seriously, I talk about several ways to identify a location. Now you can do there are three major strategies. You can either do a retrofit like an old Kmart, and I can give you an example of that if you ask me in a minute. You can also do a ground up development like we did in Minneapolis, which I did partnering with Scott Myers last year. Or you can do a value add, which is my favorite strategy because it has the lowest risk and the highest potential return of those three strategies. Now, the way to pick a location and answer your question is, first of all, you want to look at the number of square feet of self-storage in a certain radius, because self-storage is hyper local. So I could say to you, hey, the Nashville market is overheated, it's overbuilt, don't go there. But I could also take you to Belmont or Bellevue, south of Nashville, and show you that there's a whole large area there that has no self-storage and it's not at all overbuilt. So what you want to do is go to a local area like a 3-mile radius, and you want to see how many square feet of self-storage are in that radius versus the population, versus every man, woman, and child in that radius. And you want to see an equilibrium number. I mean, you should look for an equilibrium about 6.5 to 7.5 square foot of storage per person. Therefore, if you find that there's 12 square feet of self-storage in that radius per person, it's probably not a great location. If you find out that there's like 3, like the place we build in Minneapolis, or furthermore, if you find out that if you're building climate controlled and there's 0 climate controlled in a certain radius, like our place in Minneapolis that we invested in, that could be a really great location. So that's criteria number 1. Criteria 2 is you want to be on a main road with a high vehicle count, 5, 10, 20, 30,000 cars a day. Number 3, you want to be very visible in that location. Now that may go without saying, but you can be on a main road, but if you're behind a Walmart, up behind a hill with no signage, that could be a bad situation. Number 4, you want to be in an average or better than average income demographic. So, for example, if the average income in a certain area is $45,000, if you're in an area that is 60,000, that's a good location. Our Ramsey, Minnesota, which is the suburb of Minneapolis, the average income is like 107,000 per household in that 3-mile radius. So we're really, really happy about that location. It hits every one of those boxes. One more thing is you're looking for high barriers to entry for others to come in. High barriers to entry could be that you're in an urban setting where there's just no land to build or no warehouses to convert, or it can mean that the city council has said that we don't want any more self-storage. And so in Ramsey, Minnesota, the city council has already said we're only going to approve future self-storage if it's in an industrial park. Well, there's none applied for in our whole area around there. So we're really, really excited to bring this project online soon because it has that barrier to entry as well.
Okay. So I feel like a lot of that was maybe for somebody that was, at a bigger spot or at a further spot along their self-storage investing career. Now, if somebody was newer and hadn't bought hardly anything yet, is there like a unit size maybe that they should look for these mom and pop things? Like maybe don't go below 50 units, because then it kind of gets hard to like pay the bills and have an on-site manager and that type of
Yeah.
thing. Or is
Yeah.
there
Yeah.
options for all those sizes?
Yeah, so you're going to want to look for, if you want to run it yourself and it's local, then feel free to buy any size you want, especially if you can do significant upgrades, build outs, add on to it, and grow it. But if you want to be remote from it, you're going to want to either have an automated system, and there are some out there. I'm trying to remember the name. Noke, Noke. There's a no key system. There's other systems that people can operate, through a kiosk, which is outdated, or their iPhone or smartphone, and just actually pay online and get in the gate and all that stuff. So you can have any size if you do that, like, 100, 200 units might make sense. Now, if you want to get an on-site manager, you're going to want to be at a bare minimum of 350 units. And that's typically around 35,000 square feet, because we assume the average unit size is 100 square feet, which is a 10 by 10. So you're going to want to be at 35,000 square feet and 350 units minimum to afford an on-site manager. REITs, life insurance companies, pension companies, they like to buy from you if you've got it really, really beautiful and franchise-like, but they're only going to want to buy if it's above 50,000 square feet or 500 units, at least today. There may come a day that changes.
Right. Okay. And then how you mentioned finding the square footage of storage unit facilities in your area. How do you find that out? Is there websites or locations, or you call a broker and ask them?
Yeah, so you can get hold of me at my website, and I will give you a half an hour tutorial on how to do that. And I'll give you the website later if you ask. But
Mm-hmm.
I'll tell you, if you want to not wait for that tutorial, you can go to a website called Radius Plus. That's RADIUSPLUS.com. And radiusplus.com will give you 5 free searches, and then you have to pay. It's not inexpensive, but if you can get the 5 free searches out, it will give you an amazing amount of data on competition, the unit sizes, that what they're charging, and the income in any radius you want, 1 mile, 3 mile, 5 mile, whatever. It's
Okay.
amazing. It's
That's kind of like a
amazing tool.
co-star for
Yeah,
self-storage.
that's right.
Okay, perfect. And then what about financing? Can you get regular portfolio loans for this, or what type of financing is available for self-storage facilities?
Yeah, you can get CMBS loans. You can get, I think it's either Fannie or Freddie doesn't do it, but either Fannie Mae or Freddie Mac does. One of those do it. There's actually also small business loans that are very good for this type of thing. I'd recommend my friend Terry Campbell at Live Oak Bank. He finances self-storage across the country. They've been at it for a long time. He's been in the business for decades. I think Live Oak Bank is somewhere like Wilmington, North Carolina, or somewhere along the East Coast, but they finance across the country. They're the preferred lender for Scott Myers. Now, Scott Myers, if I haven't mentioned him yet, has a mastermind and a training organization that teaches people how to invest in self-storage. And we highly recommend that anybody who wants to get into it, go to Scott.
Okay, perfect. Yeah, that's great information. Now, I'm sorry, I'm just asking kind of some specific
It's
questions about
awesome.
this, just because, if people want to know. I got actually a good friend that just bought a couple of self-storage facilities. So I'm going to send him to your information. Um, so we mentioned the funding of it. How do you, two questions. What is a good return, like a good cap rate, if you would say, for self-storage units to look for? Because like we had mentioned, multifamily is getting compressed, so kind of the new norm is like 6% or less now. What is that cap rate on self-storage, and then what are some value add opportunities in self-storage that people might not know to look for?
Okay, how long do you have? No, I'm just kidding. So when I looked into value add on self-storage, I laughed. I thought, well, with an apartment, I can add carpet and paint and lighting and fixtures and countertops and cabinets and all these nice things. What would I add to 4 pieces of sheet metal and a concrete floor and a door on self-storage? Well, I had no idea. There are probably more opportunities for value add in self-storage than I've seen in multifamily for a long time. And remind me to get back to the cap rate question.
Yeah.
So um, in value adds in self-storage include things like adding U-Haul. Now let's do a quick math on this. In fact, we'll use the cap rate in this. So if I add U-Haul, let's say I paid $2 million for a facility. And let's say I put 700,000 cash in and I borrowed 1.3 million. Okay. So I got 1.3 million in debt, 700,000 equity, and I bought a self-storage facility. What size would that be? Let's say that's like your minimum, like the 350 unit self-storage facility. Okay.
Mm-hmm.
Now, let's say that the numbers make sense for me to add. My first value add would be a U-Haul. Okay. Now, U-Haul and Penske allow you to rent trucks through your self-storage facility. And the great news is you don't have to spend a lot of money to get that value add. You don't have to go, and put in $100,000 or whatever. You just sign a contract with them and you make a policy and procedure change with your manager there. And you start renting U-Haul trucks out of that facility. Now that can bring in I don't want to say that, $3,000 a month. Okay. They typically bring in $2,000 to $5,000 a month. And so let's say it's 3,000, somewhere in the range of average. Okay. I'm going to do some math here. Now let's remember our value formula.
Mm-hmm.
Value equals net operating income divided by cap rate. Let's assume the cap rate on this facility is 6%. Okay. That's the average rate of return, right? If we were able to bring in $3,000 a month to the bottom line with virtually no cost, because you've already got the manager there on site anyway, he's just going to have to work a little harder. That's $36,000 a year, right? $3,000 a month. Now divide that by the cap rate. Okay, so that's going to go straight to your bottom line.
Mm-hmm.
Divide it by a cap rate of 6%, and look at that. We just added $600,000 to the value of the facility. What did I say we had in equity? 700,000, I think, in equity up front.
Yeah.
You added $6,000 to the value. You almost doubled the value of your equity from making one policy change. Fun.
Yeah.
Now, another thing we can do
it's awesome.
is add insurance. Now, let's say we find an insurance company who will co-insure with us, who will share the profits with us. And let's say we're able to make $5 per unit per month. So that's 5 times 300. Now, let's say only 60% of the people do it, times 0.6. Okay, so that's only $900 a month. You may say, oh, that's not too much. So let's multiply that times a year. That's $10,800 per year. Divide that by the 6% cap rate. You just added $180,000 more to the value of your facility just by selling insurance. That's pretty significant. Now you've well more than doubled the value of your facility on paper, and you still haven't added any CapEx, any capital expense. Now, if you have a showroom, you can start selling locks, boxes, tape, and scissors, and that can add another, say, 5% to your net operating income, which, using our equity and debt, that means it might add 15% to the value of your equity, because it would be 5% to the value of your facility. Now, there's other value adds. Just increasing occupancy, wouldn't call that a value add, but increasing your marketing, actually having a website, increasing your rates to the market level. If you can increase your rates by 20% up to the market level, that's going to increase the value of your facility by 20%. But in theory, it's going to increase the value of your equity by something like 3x. And so maybe instead of 20% increase, that's going to be a 60% increase to the value of your equity. So you can see, if you add up everything I just said, you've well more than doubled and approaching tripled the value of the equity in this facility. And this is what the people we invest with do all day long. They find these mom and pops they pay a fair price for it. In fact, the sellers are grateful, and they often invest back in the fund when these assets are acquired. And then our operating partner is able to do this to double or triple the value of the equity, refinance the equity back out. So we're playing with house money, and then we're looking at an infinite return after that on paper if there's no equity left in the deal. And so this is just so much fun, and I'm amazed I even get to be here talking to you about doing this, because as you can see, we're able to increase the value of our partners, our investors' equity quite a bit. Now, but answering quickly on cap rate, if something was operating at a 4 or 5% cap rate, what I mean by that is if I'm willing to pay that much, let's say it's getting $100,000 a year net operating income, okay? And let's say the owner wants $2 million for it. That's a 5% cap rate. Basically, it's $100,000, which is the net operating income. We're flipping the equation around, divided by the sales price, which is $2 million. That's a 5% cap rate. If I can make the changes I just explained to you and get it up to where it's operating at a 10% cap rate, honestly, really quickly, I'm really okay with paying a 5% cap rate as long as I have that upside. Now, if there's no upside, if I'm just buying an asset that I'm just going to keep operating it as is, which I probably wouldn't do, I'd want to see a 6 to 7% or higher cap rate.
Okay. No, that's good information. What about adding, as opposed to adding more units on your property or just having parking spaces for RVs or whatever? What do you think about that?
That's a great point. We invested in an asset recently that it was actually a mobile home park, but the theory, basically the theory is the same. The mobile home park had 3 or 4 cars in front of a lot of the mobile homes. They had work trucks, trailers, and even RVs parked all around the place. And the new asset manager said, this place is a mess. So he went out, and like I said, this applies to self-storage or mobile home parks. It's the same math. He went out and he said, okay, so he paved 1 acre near the front of the mobile home park. Now, by paving it and putting a nice fence and a gate around it, he said, okay, if you've got an extra work trailer or car or RV, you've got to park it in here, and we're going to charge you to park it there. Now, when that acre is filled up, he's going to be able to bring in up to $10,000 a month from that parking. And he can actually go out to the community and, he can tell people, hey, we've got paid parking here and all that on Craigslist. And so $10,000 a month. Now that's $120,000 a year to the bottom line. He only spent $100,000 to do this. So his annual ROI on that $100,000 he spent is 120%. That's a beautiful value add. And let's just say for the moment he paid $5 million for this facility. That's $3 million in debt, $2 million in equity. So he had $2 million cash in this deal. This asset, $120,000 increase to the net operating income. Take $120,000, divide it by the 6% cap rate. That's 0.06. He just added $2 million on paper to the value of that facility by adding this parking spot. Well, guess what? He only had $2 million in equity in it. And so by doing this one change, and of course he had to work hard to get it filled up with, all the tenants. But after that, he just basically doubled the value of the equity in that mobile, if it's a $5 million mobile home park. Well, it works exactly the same in self-storage, like you said, RV parking, adding units, adding a beautiful, let's say you have an acre to spare at a self-storage facility and a lot of demand in the area. You add a 3-story climate controlled building, and you've upped the value of the facility just because you've got a nicer building on the property and you can advertise that. But you've also got a huge value add because guess what? The land was already paid for.
Yeah, no, that's all awesome. I love the value add strategy. It's so much better than residential property, just dealing off comps or whatever, you know what I mean? So that's a great strategy. So one thing I like about this too is that recently I've talked to a lot of like apartment syndicators, and people love to invest in apartment syndications with passive, like as a passive
Mhm.
investor through their IRA or 401k or whatever. And like myself, I've put IRA money into apartment deals, but you can do the same thing with this, and the returns oftentimes can be much better, especially because it's not an overinflated asset class, right?
Right. Yeah, it's
Okay.
absolutely true.
Yeah, definitely. Okay, so where are you guys going from here? Like, where do you see where the economy's going? Are you going to continue to expand and partner with more of these operators throughout the country? What's next for Wellings Capital and you personally?
Yeah, we have an extremely high criteria that are stringent criteria to get, for us to invest with somebody. And so honestly, it's pretty tough to find an operator that we like that fits us. But we're looking for more operators. We're doing that right now. We'd like to expand above our current level. But we are actually also looking toward what is the next asset class that makes sense. What makes sense to us at this point, Justin, are medical facilities because they're very recession resistant, like self-storage and mobile home parks are, and apartments are to a very high degree. We like medical, but we also like senior living. And we've got some friends who are involved in senior living who have been telling us all the reasons they love it. And we're quite intrigued. So it's something we may consider at some point.
Yeah, I had a question about this. I'm glad you brought up senior living because I was thinking, a lot of people are talking about senior living because obviously the baby boomer generation's kind of getting older and people are downsizing and they like to go into these communities. But a lot of people are talking about the next downturn. I mean, nobody knows, and this is all speculation, but I like to bring up just what people talk about, So is off most likely going to be something about the pension funds throughout America and how that might be a big collapse. So if you're in the
Mhm.
senior housing, a lot of those people are on Social Security or living off pensions from their jobs. Now, do you think the senior communities will take a big hit if that, I mean, obviously if that recession happens and its pension funds go away or whatever happens, well, now you got all these seniors that are in these facilities that can't pay their rent, I guess.
Let me tell you,
Yeah.
mobile home parks are the only asset class we know that are growing in popularity and higher demand and having a shrinking population every year. About 100 of them go away every year, and there's only about 10 rural ones built every year in the country. And one of the reasons they're so popular is that 10,000 people a day turn 65. 6 out of 10 have less than $10,000 saved for retirement. I mentioned this in a Fox Business article last November, and it stuns me to think, and I'm glad your audience and you and I aren't going to be part of that, I hope.
Hope not.
Um, but at any rate, those 4 out of 10, so the 6 out of 10 that have less than 10,000 saved for retirement, a lot of them are just going to rely on Social Security. Some of them, thankfully, have home equity, and they can trade in that home equity for a very nice mobile home, and they can drop their mortgage payment to basically lot rent, which averages only, get this, $280 nationwide right now for mobile home parks. So even if you were in a nice park that was double that, that's usually a lot less than someone's mortgage and taxes and all that they have on a house. And so it's a really good fit, and it's got great demographics for long-term growth. But you might ask, which you already did, what happens if there's a real problem with pension funds and all that? Well, it's actually going to drive more people to mobile home parks. And you ask, well, won't that drive people away from senior living? Okay, so the type of senior living that we're planning on investing in, if we do, is a very, very small sliver of the population. We're going to do demographics, and we're going to be investing in facilities that, number one, are pretty small, like 100 units, and number two, they're going to cater to only like the top 1 or maybe 0.25%, less than 1% of the community. And that's all we need to make these work. Okay. So, I mean, if there's only 100 units and we're charging, let's just say, for example, $4,000 a month for these senior living condos, let's say, which sometimes graduate to, something from an independent senior living to an assisted living level, which obviously costs more. We only need to cater to a very, very small percentage of the population. And that's critical here. And those people they're already set, and they're not going to be affected by these events that you're talking about. Typically now there's going to come a day when it changes, but right now, Justin, typically these senior living facilities have waiting lists, and they're very hard to get into. So at the time, it looks like a pretty good investment, but we're still checking it out.
Yeah, for sure. No, it's all good information. Well, Paul, I have a lot more questions I could go on to ask because I'm really, obviously interested in mobile home parks and more on the self-storage. But we don't have all the time in the world. So where can people find more information on this? You'd mentioned a website earlier that people can check out that you had information on, learn more about you and your company and what you guys are doing.
Yeah, absolutely. So I've got a free special report on self-storage investing and another free special report about mobile home park investing. And they can visit our website to get a copy of those. It's wellingscapital.com. That's WELLINGS, Wellings Capital, CAPITAL.com. And if you want to go straight for the jugular and get these reports, you can add /resources. So it's wellingscapital.com/resources, and you can get a copy of these special reports. You can book a time to talk to one of our staff, and you can also find out how you can get my book on multifamily, which is actually on Amazon, or the new book on self-storage.
Right on. What was the book on self-storage going to be called? It's coming out soon.
We don't know yet.
We don't know yet.
Bigger Pockets is testing that out. I called it The Book on Self-Storage, but they're testing out other titles like The Definitive Guide to Investing in Self-Storage, or Making Money Off People's Stuff, or something like that. I don't know. So we'll see what they call it.
Okay, right on. And then your book again on Amazon is The Perfect Investment: Create Enduring Wealth from the Historic Shift to Multifamily Housing. So,
that's right.
Right on. Well, Paul, I really appreciate you being here. Lots of good information. I wish we had more time to continue and dive into more things, but maybe we'll have you back in the future and dive into the other topics of mobile home parks and things.
Let's do it again. I'd love to. That'd be fun. It was really an honor to be here, Justin.
Right on. And one more thing. You have a podcast, right?
I do. We have a wealth building podcast that's oddly titled How to Lose Money. And the goal on that is to talk to really successful entrepreneurs and investors about their pain, loss, heartache on the way to the top. And we've got about 200 episodes of that, and we're really enjoying talking to new people every week on that show.
Right on. Well, Paul, thanks again for being here, and you have a great afternoon.
Okay. Thanks, Justin. Take care.
Bye-bye.